Hey team, it is June 2024, and for this month's Evan-omics lessons, I've got information, of course, about mortgage rates. Where have they been? Where are they going, both near term and long term? I'm going to give you an insider's perspective of the Fed's mindset. We know the Fed is likely to cut rates in their next move, but when is that going to be, and what specific economic indicators are they going to be tracking? And then finally, I've got a little lesson for you about the basics of home insurance and how that works with lending. The reason, home insurance, the market is in disarray. With climate change and a lot of the disasters that are happening, it's becoming less and less affordable to obtain home insurance. And specifically with condos, we're starting to see some issues arise. I'm going to give you a little tip to save a deal if the lender tells you that the condo is non-warrantable due to insurance. So let me get out of the way, and we'll get going here. All right, so here we are, June 2024. Where have mortgage rates been? Well, April was not a kind month to mortgage rates. You can see that on a national average basis, the 30-year fixed rate mortgage got up to about 7.5%. And then we got that favorable jobs report at the beginning of May, and that took rates from about 7.5% to just below 7% on a national average. And in the last 10 days of May, we saw rates push up to just over 7.3, and then they've come down a little bit. So they're hovering right now just above 7%. Now, long term, we still think mortgage rates are going to improve. This is a chart that shows the relationship between the 30-year fixed rate mortgage, the federal funds rate, and basically this is what it shows, that on average, 30-year fixed rate mortgages improve by about 3 percentage points peak to trough once the Fed pauses their rate hikes. And you can see out here the Fed has paused. So far, mortgage rates have improved by about 1% off the peaks of October 2023. If history repeats itself, no guarantees, we think mortgage rates are going to get 1 to 2 percentage points better in the next 1 to 3 years. Now, the Fed, of course, they're going to be looking at inflation. That's one of the things they track. And this is the most recent reading on the Consumer Price Index report. The most recent reading showed that during the month of April, prices increased by 0.3%. Now, the good news around that is that we have a pretty clear downward trend of month-over-month price increases starting back to January of 2024. And if you take a look at mortgage rates, of course, started to increase at the beginning of 2024 after reaching down to about 6.6. And primarily that was because we saw some pretty high inflation readings in January, February, and March. Well, now that inflation is moderating again, if that can continue, the Fed is going to like to see that, and that'll help them cut rates sooner. Now, looking inside the Consumer Price Index report, shelter continues to be the primary component. So based on the government's measurements, they're saying the shelter for U.S. households is increasing. This can be rent, or what they call owner's equivalent rent, is increasing by 5.5% year over year. And that's basically 2.5% of the 3.6% annualized inflation in their reading. Now, the other thing that made a really big dent in inflation this last month, motor vehicle insurance. Look at this. It's only 3.7% of the overall weighting, but on a year-over-year basis, motor vehicle insurance is increasing by nearly 23%, which is absolutely bonkers. That's adding 0.84% to this 3.62% figure. So between shelter and motor vehicle insurance, that's 3.3 or 3.4 of the total inflation. Everything else in the basket of goods is only contributing 0.27% to inflation. So long story short, I don't think motor vehicle insurance is going to increase by 22% forever. I would argue that rents and owner's equivalent rent is not increasing at 5.5% per year. That might be a little bit high. And as a result, I'm not sure inflation is as high. I think these are lagging indicators, and we should see inflation continue to decrease as time goes on. Now, the second thing the Fed looks at is, of course, the unemployment rate. Unemployment rate is still relatively low. It is higher than it was last year at this time, but it's currently at 3.9%. The Fed likes to see that around 4% or less. So it is increasing, which tells us that there is more unemployment, but the labor market is still very tight. So what are the things the Feds are going to be looking at? Well, think of it this way. If you're the CEO of a corporation and you're looking to have to make cuts, before you actually start laying off people, you're going to reduce the number of jobs that you're offering to outsiders. So the Fed is going to be watching the job openings figures, what they call JOLTS. And you can see this is on a downward trend. So again, still about 8.5 million jobs out there in the United States, but it is declining. 8.5 million jobs openings is still substantially higher than the pre-pandemic levels. So this is why the labor market is still tight. When there's a lot of job openings, companies have to offer higher wages. Higher wages creates wage growth, and that's where we can get into a wage-based inflation spiral, which the Fed definitely wants to avoid. The second thing the Fed's going to be watching is initial jobless claims. This is a weekly publication that comes out, a weekly report, and it says how many people are applying for jobless benefits for the first time. And you can see this number is hovering just a little bit over 200,000. This number is really, really low on a historical scale. The Fed is not going to get too concerned about unemployment or job losses until this number gets over 300,000. So you can see there's still a long ways to go before the Fed looks at this figure and decides that the labor market dynamics have shifted. Bottom line, between unemployment, between job openings and this figure, the labor market is still too tight for the Fed to start cutting immediately, but we're going to continue to watch these metrics, and as time goes on, we expect them to get improvement. Now, why is the economy so resilient? Economists have been predicting a recession now since the beginning of 2022. One of the reasons is because the government has been providing fiscal stimulus during the pandemic. This was obviously pandemic checks, also the infrastructure bill. Some of the climate infrastructure initiatives that the administration's put out there, that's government spending that's creating jobs and creating economic activity. You can see that currently the federal government is spending about at a clip of about 22% of annual gross domestic product here in the U.S. Now, normally 22% would be during recessions, right? So you can see in the early 80s, the economy was in recession. So what does the Fed do? Or what does the government do? They spend money to help stimulate the economy out of recession. So back in the early 80s, they got to 22.5%. During the Great Housing Recession, obviously the Fed wanted to stimulate the economy because of all the weakness in the economy due to housing. So they were spending at 25% of government outlays. And you can see that during the COVID pandemic, this got as high as over 30%, nearly 31% of gross domestic product. That number is gradually declining. If this number continues to decline, that should help soften the economy, which is what the Fed wants to see in terms of cutting rates and having lower mortgage rates ahead. Now, if you look at the money that the government has spent, you can see here that this is a monthly household savings, and you can see that back in April of 2020, the first stimulus check went out and household savings, boom, went up. We also got stimulus in December of 2020, the second stimulus check, and of course household savings went up. And the third one, once Biden was elected, the third stimulus check went out in March of 2021. Here's the thing, since then, basically since the end of 2021, consumers have been spending more than they've been making. So the savings rate is negative, and this can't last forever, right? We can even track through the FDIC and the Federal Reserve Bank. The excess pandemic era savings is now officially gone as of March 2024, which means all the money that was put out there, not all the money, but much of the money for U.S. households has now been spent. We're also starting to see credit card balances grow. This can't last forever. This means we should see a slowdown in consumer activity, which should result in a slowdown in the economy, maybe later this year, which would lead to the Fed being more likely to cut interest rates. Now, one other topic I want to touch on, if you saw my year-over-year forecast, you know that I'm watching the spread between 30-year fixed-rate mortgages and the 10-year Treasury note. So basically what this measures is the relative risk that investors see between lending money on mortgages and lending money to the U.S. government. Of course, the U.S. government is more safe. It's a safer investment, a safer loan to make, but it also comes with a lower return. So currently, the difference between the average 30-year fixed-rate mortgage, around 7%, and the U.S. 10-year Treasury note at about 4.5% is right around 2.5%. Now, historically, the spread between mortgages in the U.S. 10-year Treasury is closer to 1.75%. What that tells us is that currently investors see more relative risk making mortgage loans than they do lending money to the U.S. government. Now, this might have to do with the banking crisis that took place where Silicon Valley went under, First Republic was acquired by Chase. And so investors are worried about what's called counterparty risk. Over time, you can see this spread is beginning to decline. We would expect a reversion to the mean, meaning the spread between the 30-year fixed rate mortgage and the U.S. 10-year Treasury note comes back down to closer to 1.75%. That means that even if the Fed didn't cut rates and the U.S. 10-year Treasury note stayed at 4.5%, which is where it's at now, then mortgage rates, just with this spread tightening, would go from around 7% to around 6.25% with no other changes to the economy. So if that's all that happened, investors took a more traditional or historical view on the relative risk, we should see interest rates get about 0.75% better. Okay, let's shift gears and talk about property insurance. So per Fannie Mae, these are all the perils, the things that can cause damage on a house that have to be covered through property insurance. And how much coverage is needed? Well, Fannie Mae says that they need to have 100% of the replacement cost of the value of the improvements. Now, keep in mind, when someone buys a house, they buy the improvements, but they also buy the land. You don't have to insure the land because that'll be there no matter what happens to the house, but you do have to insure the improvements. So 100% replacement cost on the value of the improvements, or the unpaid principal balance of a loan, provided it is equal no less than 80% of the replacement cost value. So if a person has a lower loan balance, what this is saying is they can get away with a lower coverage amount. Now, here's the kicker. With home insurance premiums going up, some homeowners are opting to take a higher deductible in order to keep the annual premium lower. But the annual deductible cannot be more than 5% of the property insurance coverage amount. For simple purposes, let's just say that the insurance can't be more than 5% of the purchase price, okay? And where this is coming up is we are seeing some condo developments adjust their deductible because they've had damages, i.e., let's say water damages in the past that have been extremely costly. And so they're going back to their insurance company and saying, hey, instead of this higher annual premium that you're proposing, we'll take a higher deductible amount for that specific peril, meaning that they could have a deductible of less than 5% on all the other perils that you see in this chart, but they elect to, say for example, with water damage, or windstorm, let's say, they elect to take a higher deductible on that specific peril. And so traditionally, this means that if it's greater than 5%, the condo development is not warrantable or eligible for conventional financing. But homeowners or condo buyers can now get an HO6 policy, a supplemental insurance policy that belongs to them. And if that supplemental policy can close that gap to get it down to 5%, in other words, if that insurance policy covers the difference between 5% of the purchase price and whatever deductible the master policy has, then we can go ahead and make that an eligible transaction for financing. So there's a tip, and we're going to see more and more of this as condo master policies look to save money on the insurance premium. So there is your Evanomics lesson for June 2024. If you have any questions, I'd be honored to take them. You can email me or touch base, and I look forward to it. Thank you so much.